Welcome to This Explainer. Today, we're peeking behind the curtain of modern investing platforms to uncover the hidden design mechanics that are driving your financial decisions. If you've ever casually opened a trading app and suddenly felt this overwhelming urge to buy a stock you hadn't even thought about 5 minutes ago, well, you are absolutely in the right place. Let's talk about exactly why dark patterns deceive investors. So, let's get right into it. You know how modern mobile trading apps market themselves, right? It's beautifully done. They use buzzwords like the democratization of finance, promising to completely level the playing field and bring Wall Street straight to Main Street. But when we actually look at the data and the specific design choices these platforms make, we have to ask a pretty uncomfortable question. Are these investing apps actually designed to help you build wealth? Or are they carefully engineered to just play you by exploiting your natural behavioral biases? Well, answering that means we've got to talk about something called dark patterns. The Ontario Securities Commission explicitly defines dark patterns as user interface choices that manipulate, steer, or completely deceive you into making decisions that benefit the firm's bottom line, often at the direct expense of your own financial well-being. Look, it's not some random accident that it's nearly impossible to find a platform's fee structure or that you get a massive burst of digital confetti every time you make a trade. It's entirely by design. And the crazy thing is, it's not just an isolated trick here or there. Dark patterns actually sit under a much larger umbrella known as digital engagement practices, or DEPs. We're talking about a massive ecosystem that includes dark patterns, subtle behavioral nudges, and something wonderfully termed sludge. This whole architecture is carefully engineered by highly paid interface designers and behavioral psychologists, all working in tandem to shape your consumer behavior the literal second you open the app. To really get why this is such a game changer, we have to talk biology for a second. See, traditional finance operates on this assumption of reflective thinking. That's slow, logical, effortful reasoning. You sit down, you read an earnings report, and you make a calculated choice, right? But behavioral finance shows us that these app interfaces are explicitly designed to bypass that logic and trigger reflexive thinking. This is fast, it's impulsive, and it is deeply emotional. Basically, they want your autonomic responses making those trades, definitely not your logical brain. So let's look at the actual anatomy of these dark patterns and visualize how this deception plays out on your screen. Take a seemingly harmless push notification letting you know a new crypto asset is available to trade. It feels helpful, doesn't it? But researchers have found that these alerts actually act as an intense stimulus for dopamine release. In fact, receiving one of these notifications has been shown to increase retail trades by a staggering 25% in just the few minutes following the alert. The app is literally buzzing in your pocket, creating an artificial sense of urgency that just rips you out of your logical brain and forces you into immediate action. But it gets wilder when platforms start combining deceptive tactics. Think about quoting fees in fractions of a cryptocurrency instead of your local fiat currency. That obscures what researchers call the pain of paying, because your brain simply doesn't instantly recognize the true cost. And then, right on top of that, the second you make a trade, you're prompted to share it on social media. That triggers upward social comparison and herd behavior. It makes the whole act of investing feel way more like a multiplayer video game than a serious financial undertaking. They also heavily utilize that concept we mentioned earlier, sludge. You know when you sign up for an app and literally every single market alert, promotional email, and notification is defaulted to on? That is deliberate psychological friction. If you want to protect your own attention, you have to actively hunt through settings and toggle off every single switch manually. It makes it utterly exhausting for you to establish boundaries, which is, of course, exactly what the platform wants. Which brings us to the financial literacy trap. Who is actually paying the price for all this gamification? Well, the numbers here are just mind-blowing. Research reviewing millions of retail trading accounts found that gamification features increase user trading frequency by a massive 217%. Overtrading is basically one of the most hazardous things you can possibly do to your long-term wealth. And these apps are out here more than tripling the baseline rate of trading activity. And this overtrading, it creates a massive systemic trap, and it definitely doesn't hit everyone equally. High literacy investors on these gamified platforms do suffer. They see an annual underperformance of about 2.1% due to overtrading. But vulnerable, low literacy investors are disproportionately harmed, taking a severe 6.2% hit to their annual performance. Over the study period, this exact dynamic was responsible for destroying an estimated $1.4 billion of retail investor wealth. Let that sink in for a second. A huge chunk of that lost wealth comes down to how our brains process loss. Because a digital interface totally bypasses that biological pain of paying, that very real physical discomfort in your brain when you hand over hard cash, a whole new generation is being lured into speculative gambling that's just disguised as investing. I mean, losing $1,000 on a gamified options trade on your phone just feels like losing points in a game. It doesn't feel like losing a month's rent, even though it is. When you break down the specific mechanics, it's basically a literal formula. Variable rewards, like those random push notifications, build a slot machine anticipation loop right in your brain. Then you throw in leaderboards to spark severe FOMO and turn portfolio management into a competitive sport. And finally, loss disguising, where they use a soft, casual design, even when you lose big money, blunts the exact pain that is historically supposed to teach us caution and risk management. Okay, let's pull back the lens a bit. Let's look at the hidden profit motive, the real structural truth behind all of this.
Because at the end of the day, it's all about the underlying business model, specifically a system called Payment for Order Flow, or PFOF. Here is the playbook. The app uses dark patterns to gamify the experience. This predictably causes the user to trade impulsively and frequently. The app then routes that massive volume of trades to high-frequency trading firms. And finally, the app collects incredibly lucrative kickbacks for providing that order flow. Put simply, the platform only maximizes its revenue when you trade as frequently as humanly possible, regardless of whether you're making a dime.
And this completely exposes the misaligned incentives we're dealing with. Researchers found an undeniable 0.89 correlation coefficient between platform revenue and user trading frequency. Guys, that is an almost perfect statistical link. The more frantic and active you are in the app, the richer the platform gets. Your actual financial success is completely secondary to your engagement metrics. Now, it's not all doom and gloom. There actually is a proven fix. Natural experiments over in the UK and Canada have shown that when regulators step in and ban these payment for order flow kickbacks, the platforms are essentially forced to drop the extreme gamification. They literally have to reform their business models to actually serve the client. Researchers estimate that if we implemented this reform in the US, it could generate a staggering $8.2 billion in annual welfare gains for retail investors. Ultimately, we really just have to look right past the slick marketing. As this research quote so bluntly points out, what is aggressively sold to novices as the democratization of finance often operates, in reality, as a highly optimized system of behavioral exploitation. It is just not about democratizing wealth. It is about maximizing kickbacks through incredibly predatory digital design. As we wrap up this explainer, and as you head back out to navigate the financial tools of tomorrow, I want to leave you with one seriously provocative question to consider. What happens to an entire generation whose very first investing experience is essentially a rigged game? Are they going to become smarter, more resilient investors, or will they just walk away from the wealth-building power of the markets entirely? Keep an eye out for those dark patterns, folks, and always protect your reflective thinking.